So in our previous video, we covered tax strategies as it relates to your non-retirement investment accounts. Oftentimes what we see is people focusing on how can I save as much money on taxes today on their investment accounts or their overall financial plan. And that's a very important component to being successful, keeping more of what you make. But it's also equally as important to be forward-looking to potentially put yourself in a very low tax situation when someone actually retires. And so we're going to cover some of those ways to save some money on taxes today on your investments and also come up with some creative planning opportunities to put yourself in a low tax situation when you actually retire.
So let's walk through 5 of these strategies that G just referred to.
One of those strategies is to implement something called tax loss harvesting. As we all know, markets are volatile and not everything you invest in goes up in a straight line. So let's say, for example, you bought an investment for $30,000, and because of the volatility in the marketplace, at a certain point in time, that investment is now worth $25,000. On paper, that's an unrealized loss. If you actually sold the asset, you would have a recognized loss of $5,000. If you don't have any capital gains during the calendar year, you can use 3,000 of those losses to reduce your ordinary income, and you can carry forward 2,000 of those losses into the next tax year. Why is that beneficial? Well, let's say the next tax year you sold an asset at a $3,000 capital gain. Ordinarily, you'd owe taxes on $3,000, but because you banked $2,000 of losses, you only have to pay capital gains taxes on 1,000 of the 3,000. It's a concept called tax loss harvesting.
So let's say you like that actual investment that you sold in G's example. You have to wait 31 days to buy that investment back to avoid what's called a wash sale rule in order to realize that capital loss.
What you can do is buy a like-kind investment. So let's say you sold a technology stock at a $5,000 capital loss. You can buy a like-kind technology ETF or index fund after you sell it. That way you're not out of the market. And then 31 days later, evaluate, do I sell that technology ETF or index fund and go back to the stock or keep it and retain it? A second thing we see in our practice is when clients come in and they have actively managed mutual funds inside of their taxable account. So Chris is going to talk about some of the strategies you can implement as it relates to the timing of when to buy and sell mutual funds, if appropriate.
Actively managed mutual funds have to distribute any recognized capital gains they incurred throughout the year. These typically happen in the fourth quarter of the calendar year. In order to avoid these capital gain distributions, you may want to consider buying the said mutual fund after that distribution is made. Therefore, you're not buying the mutual fund, not benefiting from the gains, and then incurring a tax liability given the capital gain distribution that's made.
So in lieu of buying an actively managed mutual fund where you have no control over the tax liability the fund manager has, you can actually take on a different approach, and you can actually invest in individual stocks, individual bonds, or ETFs or index funds that are passively managed. This way you have control over the tax liability versus having no control over that tax liability. A lot more efficient way of investing where you maintain control.
A third strategy to think through is called asset location. This is a concept of positioning different types of investments in different types of accounts. Example, corporate bond interest is taxed at your highest marginal rate. You may want to have your corporate bond portfolio in your IRA because we know that that is tax deferred until you start taking money out of that type of an account. Dividend payments from a company such as Dominion Energy are qualified. This means you receive capital gains treatment on the dividend payments. So you may want to hold those type of stocks inside your taxable brokerage account because you're getting a lower tax rate than your highest marginal rate.
So the previous 3 examples, we've discussed how to save some money on taxes today inside of your taxable investment accounts. The next couple examples really walk through a forward-looking planning process as it relates to your investments and your overall retirement planning. Let's say you've done the math and you recognize that it's going to take $100,000 a year for you to live off of, and you would like to retire by the age of 60. Let's say you've been generating $30,000 of dividend income from your investment portfolio, and based on previous examples, that dividend payment was taxed at 0, 15, or 20%. Let's say you've done some forward planning and you've accumulated enough cash at the bank where you can draw on some of that cash the first few years of retirement to supplement your dividend income. If you need $100,000 a year to live off of and you've generated $30,000 of dividend income and you draw $70,000 from cash, you've put yourself in a very low tax situation. That dividend income that was taxed at 15% or 20% while you were working is now potentially taxed at 0% because you have very little earned income.
The fifth strategy is Roth conversions. The old rule of thumb used to be put all of your money currently in pre-tax vehicles because you're going to be in a lower tax bracket in retirement. That may not be the case anymore, given potential inheritances from family members, deferred compensation payments, etc. If you're in this category where your income may be higher in the future than it is while you're working, you may consider a Roth conversion. A Roth conversion is simply when you're converting your pre-tax retirement dollars into Roth dollars. There's no limit on how much you can convert in any given year. However, you will be paying income taxes at your highest marginal rate on whatever amount you convert.
As you can see, the fourth example can lend itself to a great transition to a Roth conversion, where you're generating the desired amount you need for retirement, putting yourself in a low tax situation, therefore allowing yourself to convert money from your traditional IRA into a Roth IRA at lower marginal rates. At the end of the day, we want to keep more of what we earn. Some of the strategies we discussed may be pertinent to you, but you have to understand everyone has a unique set of circumstances and a unique set of goals.
Some or all of these strategies may be right for you. At the end of the day, we're trying to come up with a tax-efficient game plan as it relates to your overall financial plan. An advisor at Virginia Asset Management can help you walk through these different strategies and help you implement whatever is right for you.